Turning to the broader economy and monetary policy. Inflation remains too high, and the labor market continues to be very tight. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. Committee participants generally expect subdued growth to continue. Yet the labor market remains extremely tight. Job gains have picked up in recent months, with employment rising by an average of 351,000 jobs per month over the last 3 months. The unemployment rate remained low in February at 3.6%. The labor force participation rate has edged up in recent months, and wage growth has shown some signs of easing. However, with job vacancies still very high, labor demand substantially exceeds the supply of available workers. Inflation remains well above our longer-run goal of 2%. Inflation has moderated somewhat since the middle of last year, but the strength of these recent readings indicates that inflation pressures continue to run high. The process of getting inflation back down to 2% has a long way to go and is likely to be bumpy. At today's meeting, the committee raised the target range for the federal funds rate by a 1/4 percentage point, bringing the target range to 4.75% to 5%. And we are continuing the process of significantly reducing our securities holdings.
Now, the Federal Reserve was adamant about hiking rates long before the collapse of SVB, Signature, and Credit Suisse. And given the Federal Reserve isn't here playing poker with us, as I always like to say, it was a no-brainer that they were going to follow through with their recent 25 basis point rate hike. This means the terminal rate will now reside at 4.75%, and according to several Federal Reserve officials, we could even see the interest rate pop above 5% sooner than we think. But to ensure you have the whole picture in mind as to why rates are being hiked, you have to know that inflation remains stubbornly high at 6%, which is obviously down from the 7% plus we saw months ago, but far from our 2% inflationary goal, with the employment report depicting an additional 311,000 jobs recently added to the U.S. economy, which really was another key driving factor in the Federal Reserve's recent decision, as the labor market is as robust as ever. But what does that really mean for our future? All in all, pain, and plenty of it is to come in 2023, potentially even into 2024. Now, we've yet to really see sector-by-sector layoffs, which I've been sharing are necessary, and until then, I only expect a hawkish Fed and strife for business.